All right, let's get right into it. There's a massive story brewing, but you won't find it on land. We're talking about a new kind of trade war between the U.S. and China that's happening right now, out on the open ocean. And trust me, it's about to reshape how everything gets to you. And it all kicked off on a very specific day, October 14th, 2025. Yeah, this isn't some far-off prediction. It's the day the starting gun was fired on this new reality for global shipping. And boy, did the industry feel it, like, right away. So, let's break this down. What is this port fee war, anyway? We're going to get into the nitty-gritty, the new rules of the sea that have, well, basically everyone in logistics completely buzzing. And it really all boils down to one simple but, incredibly expensive question. How much does it cost now for a giant ship to pull into a port? Whether it's in the US or China, the answer, well, it's gotten a whole lot more complicated. Okay, so the US made the first move. They've rolled out this two-tier system. You've got a $50 per ton fee if the ship is Chinese-owned, then there's a smaller fee for any ship that was just built in China. China, of course, didn't just sit back. They came back with their own fee, a little bit higher at $56 a ton for any US-affiliated ships. But here's the real kicker. This is just the starting point. Both sides are already planning to hike these fees up through 2028. Okay, Section 2, let's talk about the money, because when you start adding up these fees for thousands of ships every single day, the numbers get absolutely mind-boggling, and they get there fast. We're talking billions. How mind-boggling? Well, some analysts are throwing around the number $12 billion. That's the estimated hit to global trade every single year. That's a huge new cost that gets injected right into the system that brings you, literally everything. Your phone, your clothes, even the food you eat. But where it gets really fascinating is when you zoom in from that massive number to what it means for a single company. Take COSCO, the Chinese shipping giant. A single port call in the US for one of their big ships, that just went up to about $3.25 million. And by 2028, that same visit could cost over $8 million. Add it all up, and their bill for 2026 alone could top $2 billion. And get this for a plot twist. It's not just Chinese companies. An Israeli shipping line called Zim is looking at a $500 million bill. Why? Just because some of their major investors are American. It's that interconnected. And this chart really drives home just how big this problem is. We're not talking about a handful of ships. When you factor in who owns the ship, who financed it, where it was built, HSBC thinks that up to 40% of the entire global fleet could get hit with these fees. That's not a small problem. That's a shock to the whole system. All right, so if you're a shipping company staring down a $12 billion problem, you're not just going to sit there and write checks, right? Of course not. They are scrambling, and the way they're fighting back is literally redrawing the map of global trade as we speak. And it really comes down to three main plays. First, they're redeploying ships. Think of it like a giant swap. Alliances are moving their Chinese-built ships over to Europe and Asia and bringing their European-built ships to the US routes. Second is transshipment. This is clever. They drop cargo off at a neutral port, think somewhere in the Caribbean, and then a clean ship picks it up for the last leg into the US. And third, there's some serious financial gymnastics going on, restructuring deals to get away from Chinese leasing companies so their ships don't get flagged as Chinese-owned. And all of this shuffling is already tightening the market. I mean, just listen to the CEO of Navios Maritime Holdings. He said the fleet of ships available to call on Chinese ports is now clearly smaller than before. When you have fewer ships available, what happens? Prices go up. It's a classic capacity squeeze. So that $12 billion question, where does all that money come from? Well, it doesn't just vaporize in a boardroom. The consensus is it's going to land right on the price tag of, well, everything. We could all be looking at a 3 to 5% price hike on imported stuff by early 2026. This hits all of us. Which brings us to a huge question. Why? What's the end game here for the US? Let's look at the official reason and then stack that up against the cold, hard facts of the global market. The stated goal is pretty direct, actually. President Trump put it plainly. We will revive the American shipbuilding industry. The idea is to kickstart the whole sector for both commercial ships and military ones. Okay, but then you see this chart. And the scale of that challenge is, honestly, it's hard to wrap your head around. In 2025, China builds more than half the world's ships. South Korea and Japan handle most of the rest. The U.S., we're at 0.1%. It's barely even a sliver on the chart. And the why behind that tiny number all comes down to money. A state-of-the-art container ship from a Chinese shipyard costs about $295 million. To build a similar ship in the United States would cost, according to the experts, anywhere from 2 to 4 times that amount. That is a massive price difference that these new fees might not even begin to cover. So this all leads us to the real billion-dollar question, the one everyone in the industry is asking. Is this whole thing just a high-stakes bargaining chip for some upcoming negotiations, or are we looking at the start of a permanent, fundamental shift in how the world does business? And things are moving fast. Remember, the fees just kicked in. There's a huge summit between Presidents Trump and Xi happening at the end of this month. And we know the fees are set to keep climbing until 2028. It's a really fluid situation. Anything could happen. You know, right now, the experts are pretty much split down the middle. On one side, you have the people who think this is a classic negotiating tactic. Create a big problem, use it as leverage at the APEC summit, and then trade it away for something else. But the other side says, no way. They're looking at that shipbuilding gap, the 0.1% versus 53%, and saying that's not a problem you can fix in a single meeting. They see this as the start of a long, probably painful reorganization of the global economy. And honestly, no matter who's right, the near future is going to be a mix of big risks and big opportunities. The risk is pretty obvious, right? More chaos, higher prices for everybody. But look at the flip side. This could be a huge opportunity for shipbuilders in South Korea and Japan, who might get a flood of new orders. And all those smaller hub ports in Southeast Asia and the Americas, they could become the new superstars of global shipping. Okay, so we've looked at the fees, the money, the strategies. What's the big takeaway here? What's the one thing you should remember from all this? Here's the bottom line, as I see it. It's entirely possible we'll see a political deal at the APEC summit that kind of hits the pause button on all this. But that won't fix the fundamental problem. That massive gap in shipbuilding and logistics isn't going away. So this whole period, from now until 2028, is probably best seen as a messy transition. We're moving to a new system, one that's more complicated and almost certainly more expensive. This is so much bigger than just some port fees. It's about redrawing the entire map of global trade. And that really leaves us with one last big thought. Are we watching the end of the global supply chain as we've known it for the last 30 years? Or is this just the messy, complicated beginning of whatever comes next? Hey, thanks so much for sticking with us through this deep dive. We really appreciate you spending your time with us as we try to make sense of these huge changes happening all around us.